Okay, let's dive in. Today we're looking at a fascinating situation, really a bit of a paradox in the energy sector. How does a major global player hit record production levels? I mean, absolutely massive cash flow, while commodity prices are actually lower than they were a year ago.
Yeah, that paradox is exactly what jumps out from the Q3 2025 earnings materials we've been digging into. It really comes down to execution. We're looking closely at how they pulled off the huge Hess integration that was a massive deal and how they're keeping such tight control on spending, capital discipline, even with all the market ups and downs.
Right. So our mission here is basically to give you the shortcut. We've gone through the earnings call, the reports, and we're going to unpack the company's financial health, their operational speed, especially how that big acquisition is working out and the strategic shifts they're making around the world, all focused on how they protect that cash flow. All right, let's start with the financials, the wallet, so to speak. The headline figures look really strong. Q3 reported earnings, $3.5 billion. That's 1.82 per share. Adjusted earnings were a bit higher, $3.6 billion, or 1.85 a share.
And it's worth noting there were some special items in there, about $235 million in costs, mostly tied to the Hess deal, things like severance, transaction fees. But those were partly offset by some fair value adjustments on the books.
But the number that really caught my eye was production. Record worldwide net oil equivalent production. It went past 4.1 million barrels per day. That's huge.
Yeah.
A 21% jump from last year.
Exactly. And that ties directly into the cash flow story, which is where you really see the strategy playing out.
Yeah, talk about that. Cash flow from operations now. This excludes working capital changes, hit $9.9 billion. And here's the kicker. That's a 20% increase compared to Q3 last year, even though crude prices were, what, $10 a barrel lower?
That's right. They were dealing with Brent around $69 a barrel this quarter compared to $80 last year, so generating more cash on lower prices. That really tells you a lot about their efficiency and cost control.
How are they doing that? Is it just the new assets?
Well, the assets help, but it's also the new operating model they've rolled out. They say it's fully live now, and it's already delivering something like $1.5 billion in annual structural cost savings, run rate savings. That kind of discipline basically acts like an internal buffer against volatile prices. Pretty impressive.
$1.5 billion in structural savings.
Hmm.
That's a significant number. That implies some major changes, right?
Yeah.
Not just trimming around the edges.
Absolutely. Management talked about reducing complexity, cutting bureaucracy across the board. The clear implication is, yeah, major structural adjustments happen to make the whole operation leaner and extract more value.
And they manage this growth while keeping spending in check.
Seems so. Organic capital expenditure, their CapEx, was $4.4 billion for the quarter. That keeps them on track for their full-year guidance, which is $17 to $17.5 billion, and that includes the Hess assets.
So hitting CapEx targets, but production is way up. That points straight to the Hess integration, doesn't it? It must be working really well.
Oh, absolutely. It's firing on all cylinders. Just look at the contribution from the legacy Hess assets alone. They added 495,000 barrels of oil equivalent per day, MBOED, to those Q3 numbers.
Wow.
And management is saying the integration is actually ahead of schedule. The assets are performing better than they expected, and they confirmed they'll hit that $1 billion run rate synergy target this year.
That $1 billion synergy target always sounded ambitious for a deal this size. Are there still big risks, or is it basically locked in now?
Well, integration work is never totally done, but the financial targets look very solid, clearly de-risked. The main engine behind a lot of this, of course, is Guyana. And the news from there just keeps getting better.
Right, Guyana. We saw first oil from Yellowtail. That's the fourth big project in the Stabroek Block.
Fourth one, yeah. And hot on its heels, they announced they're sanctioning the Hammerhead project. That'll be the seventh development there. It just provides this incredible line of sight for growth, for the next decade plus.
It really does.
And going back to the people aspect you touched on earlier, the CEO made a point of highlighting the quality of the team they inherited from Hess, said it represents a huge amount of value. He emphasized that keeping those talented people was really critical for making the whole operational integration work smoothly.
Okay, let's shift from deepwater Guyana back to the U.S. shale performance, particularly the Permian. Sure. Efficiency seems to be the mantra there.
It really is. And there's a key operational detail here. Permian production went over 1 million barrels a day, plus an extra, 60,000 BOED on top. But here's the interesting part. They did this using fewer rigs and fewer frac crews completion spreads than before.
Fewer rigs.
Technology improvements, continued efficiency gains. They talk about running it like a steady manufacturing operation. Production isn't something they chase by just throwing more capital at it. It's treated as an outcome of being efficient.
And the other Hess assets fit into this, like the Bakken.
Yeah, the Bakken, another legacy Hess play, is now holding steady at a plateau around 200 MBOED. Management's looking at its long-term fit, focusing on capital efficiency. They're applying lessons from other areas,
Like what?
specifically things like drilling longer laterals. Drilling further horizontally from one spot, that lets them access more rock with less surface impact and hopefully lower costs per barrel.
Got it. And beyond these big basins, any other operational highlights?
A couple, yeah. In the Gulf of Mexico, the Ballymore project hit its design capacity faster than planned. And on the new energies front, they got first production from the ACS Green Hydrogen project out in Utah, so movement there too.
Okay, let's talk about TCO, Tengizchevroil in Kazakhstan. That's always been a huge cash contributor, right?
A massive cash engine, yes. And the affiliate dividends from TCO have actually been better than expected this year, mostly due to really reliable performance after they got that future growth project up and running. It's basically running at nameplate capacity.
But they did guide lower for Q4 dividends from affiliates, didn't they?
Yeah.
Dropping to maybe almost $0.8 to $0.9 billion. Why the dip?
Good catch. Yeah, there are two main reasons for that lower Q4 guidance. First, there's a big planned maintenance shutdown, a turnaround, scheduled at TCO in Q4. That will obviously impact production temporarily. Second, TCO itself needs to hold on to some cash. They've got a couple of significant loan repayments coming due in 2026, so a bit of strategic cash conservation.
And what about the bigger picture there, the concession renewal talks with Kazakhstan?
Management mentioned that they characterized the discussions with the president as complex, and just at the beginning, it sounds like a long process.
Those kinds of government negotiations always carry risk. How are they balancing that geopolitical side with needing TCO's cash flow?
Right now, it seems the focus is on keeping TCO running flawlessly, maximizing the cash it generates today, and like we said, managing the dividend carefully to build that cash buffer for the debt. The message seems to be, these talks take time, let's be patient and methodical.
Okay. Shifting continents again, let's touch on Argentina and the Vaca Muerta shale. They're expecting some growth there.
Modest growth, yeah. Around 25 MBOED expected in 2025. But the longer-term view seems quite optimistic. They sound encouraged by what they called improved macro signposts under President Milei's government.
Like what specifically?
Things like stabilizing the banking system, easing up on capital controls, stuff that makes it easier to invest and operate. And fundamentally, the rock quality in the Vaca Muerta is world-class, highly competitive.
So potentially a bigger piece of the portfolio down the line.
Potentially, yes. Management suggested that if the policy environment continues to improve and stabilize, Vaca Muerta could actually start competing seriously for capital against other parts of the portfolio, maybe even the Permian someday.
Interesting. And this renewed optimism, maybe in places like Argentina, seems to tie into a broader shift we're seeing in their exploration strategy.
Definitely. For years, exploration spending was quite constrained, focused mainly on safer, mature basins. Now it looks like they're shifting to a more balanced approach.
Tell us how.
They're still investing in the mature areas, but they're also deliberately stepping out into higher impact frontier exploration plays again, early entry. They specifically mention new entries in Suriname, Brazil, Namibia, Nigeria, and Angola. That's a significant geographical spread.
That's quite a list. It signals a bigger appetite for risk, for finding the next big thing. Is that a fair reading?
I think so. It suggests a renewed commitment to organic growth through the drill bit, even in riskier areas. But they emphasize they're being thoughtful about it.
What does thoughtful mean in this context? After years of caution, jumping into 5 frontier areas sounds like a big move.
Well, take Namibia as an example. They drilled a well there recently. It didn't find commercial hydrocarbons, unfortunately. But they stressed the main goal of that first well was actually to gather data, seismic, geological info, and they said they achieved that.
So learning before leaving.
Exactly. They still sound optimistic about Namibia. They've farmed into some new blocks there. They have a permit for up to 10 wells, but they made it clear they're not just going to drill blindly. It'll be driven by the data. And maybe the strongest signal of this shift is they hired a new head of exploration, someone from Total Energies. That usually indicates a real focus and resource commitment.
Okay, quick pivot to the downstream side of the business. Portfolio balance still heavily weighted towards upstream?
Yep, pretty stable mix, about 85% upstream, 15% downstream. And the CEO basically said they're comfortable with that. They believe upstream returns generally hold up better through the cycles compared to, say, refining margins.
But there is one growth area downstream.
Petrochemicals, yeah. That's where they see downstream growth. They have those big CP Chem projects, joint ventures with Qatar Energy. These are designed to be world scale, very low on the cost curve. They're forecasting pretty strong returns, like 20% IRR when they come online next year.
And lastly, the refining market in California. That always seems challenging.
It is. Management acknowledged the supply situation there is getting tighter, and they pointed directly to state policy as the driver refineries converting to other uses or closing down.
So more reliance on imports.
Exactly. The market is shifting to bring in more products by ship. There's talk sometimes about new pipelines to help supply California, but management called those ambitious projects, basically very complicated to get permitted and actually built in California's regulatory environment. Oh, and they did briefly address the recent fire at their El Segundo refinery. Just confirmed they're cooperating fully with regulators, focuses on safety.
Okay, so we've covered a lot of ground Permian efficiency, the huge Guyana expansion, major cost cuts, this shift back towards frontier exploration. Stepping back, what's the core takeaway for you, for the listener, trying to make sense of this quarter?
I think the big picture from these Q3 results is a company that's just executing a very consistent, very disciplined strategy. They're doing it across really volatile markets, tricky geopolitics. The key theme is resilience, generating significantly more cash even with lower oil prices. That comes down to the structural cost cuts, the efficiency gains, particularly in the Permian, and really nailing the Hess integration. That's adding a lot of value.
Right. So key things for you to remember. Record production, over 4.1 million barrels a day. Strong adjusted free cash flow, $7.0 billion, which more than covered the $6.0 billion they sent back to shareholders through dividends and buybacks. Confirmation they'll hit that $1 billion Hess synergy target this year. And that strategic pivot, dipping their toes back into frontier exploration, especially around the South Atlantic. And let's leave you with a final thought to chew on. It's something the CEO mentioned that was quite interesting. He talked about how their base operations, some of their biggest legacy assets like TCO in Kazakhstan or Gorgon in Australia, they're designed in a way that makes them facility limited, not necessarily resource limited, meaning the infrastructure, the plant capacity is the bottleneck, not the amount of oil or gas in the ground.
Right. Facility limits often mean lower, flatter production decline rates. It makes the base output much more stable, more predictable, less capital needed just to stand still.
Exactly. So the question to ponder is, could this strategic portfolio design having these massive, stable, facility-limited assets that don't decline sharply actually be a kind of quiet advantage, especially as the industry navigates the longer-term energy transition and maybe needs more predictable, lower-intensity base operations? Something to think about. We'll catch you on the next Deep Dive.